Just wanted to point out the information we provide today is of a general advice. If you do want some more information, please seek some professional advice.
Another episode of the Retirement... Welcome to the latest episode of the Retirement Living Podcast, where we have real conversations with Troy Riewoldt and team from RFS. My name's Greg Black. I'm the General Manager, and I have Troy and Brooke in the studio with me today. How are you both?
Very well.
Good, thank you, Greg.
Had a good start to the year?
Yes, busy starts the year.
Busy start?
Yeah, been good.
Fantastic. Well, it's this is the first recording we've done for 2026, which is exciting. All the team are back, and this is sort of a bit of a surprise for both of you as well. I was actually coming down, Kaylee from the office sent through an email, which I thought would be quite a nice way to sort of start this conversation. A few testimonials that we've actually had come into the office over the last, really from January, which is fantastic given it's early February. So I'll read a couple. I won't bore the listeners with too many, but I think it really does go to the heart of who we are as a business, and certainly I thought would be of interest for people listening. One client wrote, very experienced and knowledgeable team, very easy to deal with, great customer service and follow-up, very professional and always friendly and approachable. And obviously that's something that we certainly do pride ourselves at RFS Advice. Another longer-term client, I would describe my experience with the team at RFS to be friendly, helpful and professional. We have been with RFS for about 5 years and are very happy with the service they provide, which is lovely. And look, this is one that just really stood out to me. Efficient service and invaluable advice made a very distressing situation easy to navigate. And I think, we're often talking on this podcast about, retirement living and planning for people's retirements. It's just so nice to actually receive testimonials from clients where, as a business, as teams, we've been able to assist them. So anyway, I know that's a little bit sort of off topic for today, but I just thought it was a good way to start the first podcast for 2026. Any surprises there, folks?
Only the fact that when you go, I know I brought this and I haven't told you in advance, but it was a nice surprise, so I'll take that one.
I normally wouldn't do that. But look, obviously we have Brooke here with us today, and for those that may not be familiar, Brooke's been with the business for nearly 9 years, is a shareholder in the business and advisor, works very closely with Troy in his team, and I guess within the business you do specialise in that, helping women with financial planning and really, I guess, that whole ladies we can talk concept as well.
Yeah, absolutely. I think there's such a need for that in Australia, and it's something we've definitely noticed the demand is there for over the last few years. It's been more ladies that are reaching out, whether they've been through divorce, they're recently widowed, or they're really wanting to take that independence of their finances and have that control and security. And it's, a lot of what we're seeing walk through the door at the moment.
Which is fantastic. And look, this is the third podcast. We've had two previous ones, which we did the Ladies Let's Talk, and then also the checklist for women over 50. And look, the feedback we've had from that's been fantastic, and we're certainly getting a lot of calls. You wanted to talk today about something that you're just starting to hear a lot of questions about and I guess comments. So do you want to just sort of share with us and I guess open up the conversation?
Yeah, definitely. So I think it's as soon as you turn on the news at the moment, you're starting to see more discussions around volatility on the news and those movements that we're seeing in the share market over the last 12 months in particular. And we're noticing that's really shifting the conversation when people are walking through our door. They're having more questions around what is risk, how do we manage this, and why do we need to have some sort of exposure to a level of risk to achieve our financial goals there. So it's something that we're really looking to do more education with, and the more educated people are, we find the more comfortable and secure they feel with their finances.
So when you're looking at talking about risk, what are we really talking about?
Yeah, so it's really coming down to stop fearing that word risk and exactly what you said, what is risk? And there are different types of risk out there, and it's really that uncertainty of an outcome is the fundamental basis of it. And there are different types, so it can be the risk of losing money short term, and then there's also the risk of not having enough money long term to live out your retirement and the desired lifestyle that you're looking for as well. So we can see that's the bit of the juggle that people have at the moment, which is cash can feel safe, but it can be more risky over decades as we do see inflation start to erode away cash. And sometimes avoiding risk doesn't necessarily mean avoiding loss. It can just often delay it if it's going to be eaten away by the cost of living. And that's something as well that's been so topical over the last few years. You go to the groceries, and what you used to be able to get for $50 now is a lot less than what you could have got for $50 even 3, 4, 5 years ago, we've seen that dramatic shift across the cost of goods across the board, really.
Troy can remember when you used to be able to buy a paddle pop for like 20 cents.
Oh, that would be nice.
But just on that, Troy, are you finding that the whole discussion around risk and volatility and things like that, a lot of it is really just a flow on from what we're hearing in the media, also what we're seeing in markets? Like there must be times like at the moment where there's a bit of noise out there.
Yeah, particularly when ladies come in, there is that, I'm risk averse. So,
Yeah.
Okay. Didn't really ask a question yet. Sometimes it
Yes.
just comes out. It's like, okay, well, let's explore. What does that mean?
Yeah.
And that's probably going up a few levels. Is it, I'm worried about running out of money? Am I worried about returns? Am I worried about volatility? What am I actually worried about?
Yes.
And what am I risk averse about?
Yes.
Because it could be I don't want to trust another planner. I don't want to trust someone with my money. There's so many risks it could be. Before we get in the granular of it's a risk profile and it's this and that and share markets, I think it's broader than that. Is what are we concerned about? What's keeping you up at night? You know, a lot of people, what's top of mind, will ask what's top of mind brought you today, and they'll blurt something like that out. And it's okay. How do we open up that can of worms? Because it's what brought them here today. Was it a divorce situation? Is it a husband's past? Are they now having that burden of decision making? I've had two in the last couple of weeks there that we had in, and we're sitting there with them, and really it was around those topics of just empowering them to make decisions. One of them was, kids asking for more proceeds. They've already helped. Have I helped enough? Have I got enough for me? Her risk was, if I give it all away, have I got enough? And while everyone would love to give everything to their kids, maybe not.
Yeah. Yep.
But that was what she was concerned about.
Yes.
And the conversation with the kids is all, how much are you going to give us and when, rah, not should we, can we,
Yes.
and is it appropriate, and is she okay?
Right. And so, Brooke, are you finding the same sort of thing when you sort of, and it's hard to sort of pigeonhole clients and so forth, but for those clients that may have gone through divorce, are they approaching risk and have they got the same sort of concerns as those that may have been widowed? Because obviously the scenario is very different. However, they're both now effectively looking after their own wealth. Is there much of a difference in how they think about things?
There can typically be a bit of a trend one way or the other.
Yes.
It's never one case fits all for a particular experience that they've gone through, but we do tend to notice that those that have recently lost a partner are often more conservative and trying to reduce risk because they've just gone through something so significant, and they're starting to really feel protective of what they've got. They're the only decision maker, and they're wanting to make sure that can get them through. That applies really for both situations. It's not a one case fits all there. Those recently divorced, we find often can be a little bit more aggressive in their decision making going forward. They might want to do the opposite of the experience they've had from ex-hubby. They might want to completely change their current strategy and look for something that will make going forward different. They're in that more change and acceptance of change, whereas those recently lost a partner, typically they're looking for less change and trying to reduce potential variations in outcome.
So education must be key to that then.
Absolutely, and it's, as Troy said at the start there, it's understanding what their concerns are and what their view of risk is, and then how do we manage that? How can we reduce risk? If they're concerned about volatility, then have we had that discussion around whether they've got enough cash and fixed income to live off of the short to medium term needs, and then spreading that diversification out through the growthier assets there that are going to really work for them long term and give them that security that they're going to have enough capital to be able to live out the life that they want to live and be able to afford the things that are essential, such as down the track it's more healthcare and aged care is a consideration as well. So you can't just sit in cash and let that be eroded over time because life doesn't necessarily get cheaper. It can still have other expenses. If it's not travel, it can be health.
Yeah, okay then. No, that's any comments from you on that, Troy?
No, it's a journey depending on the speed of the individual. So some will come in very definitively. We had a lady in the other day. She was exactly at that point. X would have done this. I want to do the opposite. So I went, okay, very clear.
Yes.
Others, it's a journey over time, and we've had some join and they're wanting that. They keep asking for that education, and that's really where how much is enough education. You don't want. Unfortunately, there's education overload, or they get themselves caught up in too much So it's juggling between the two of those, empowering them to make decisions and move forward, but not crippling them with, I need to know more, I need to...
Yes.
Where's the point of I've got enough knowledge to move forward? And, you've got one at the moment there that we've given more and more education, and I fear this person's just in that loop.
That bit of a loop, yeah.
Yeah, as opposed to making the step moving forward and has more than enough knowledge to make an informed decisions moving forward, but it's just that anchoring on that, it's safer if I sit in cash, it feels good, I'll just re-roll it for another 6 months. That's fine, they can continue to do that if they've got enough funds, and that's okay. Inflation's going to eat it up over time, but that if they're comfortable, that's fine. But it's just, when you see people struggling with that loop, it's hard sometimes to give people enough information without being too much, and that balance is really the key, I suppose, depending on the individual.
And confidence really comes into play as well, doesn't it?
Absolutely.
And I think that's, I know we've had conversations in the office about, ladies that have come in and they haven't had the confidence to make decisions, and by working with you and you educating them and giving them that self-belief that they can be involved in these decisions and they should be involved.
Yeah.
It's so refreshing that they get to a point where all of a sudden it's like the shackles nearly come off.
Yeah.
And they're able to actually make decisions. And as a professional, that must be nice knowing that, well, they're nearly on the path.
Definitely.
You're always there to help and provide support, but they're just empowered to make decisions themselves, which...
Yeah, so we're really trying to foster that environment for them to be able to make an informed decision and give them the education and the tools that they need, and everyone's going to have that different level. And it's really about finding their new normal. Whatever situation or trigger events brought them in our office, it's all right, how do we make a plan to deal with this? How do we get you in the right position going forward, and then move on from that with a sound strategy in place and a professional to lean on when certain things pop up, because they do. That's life. Things always happen. Scenarios always change, and it's making sure that we've got a plan to be able to deal with that, and that they've got someone they can lean on for that support.
So when you say you've got a plan, and I think this is where it would be interesting for people to understand how we actually go about managing the risk. And obviously we do that through, I guess, a number of different factors, and one of those would be portfolio construction. Do either of you, Troy, you obviously love the investment side, but Brooke, interested in your thoughts as well, as far as the way you think about managing the portfolio to help align the risk tolerance within the portfolio to that of the individual?
Yeah, absolutely. So a way I really love to explain it to clients is through a bucketing strategy. So I try and allow them to be able to visualise that they've got different buckets and they're different levels of risk. So they'll have their cash, that's their immediate access, that's liquid, available to meet their short-term cash flow needs. Yes. Then you'll build up, and it will, firstly, actually back to the cash there, the cash is going to offer that stable, low risk, but you're also sacrificing the lower returns for that. And that is the cost of that convenience, and that you're paying for the certainty of that cash being available and liquid and not technically going backwards, but technically is with inflation. Yep. So it's that juggle. And then you build up from there. We'd also usually hold a fixed income buffer on top of the cash, so that can earn a little bit more, but again, it's still very defensive in its nature, so it's going to offer less volatility, but also less potential for returns over the longer period.
Yes.
And then you can build up into more growth assets. So you've got your shares and your property. That bucket's your growthy long-term assets that you really want to leave there to continue to compound away and have that benefit of reinvesting over time. Depending on stages of their life and where they are, whether they're income drawing or reinvesting, you can continue with that bucket to grow. It's going to have more risk, more movement with the markets, but if you can separate that from the other ones, then you've got access to capital should you need it.
Because the reality is if that part of the portfolio drops, well, you're not accessing, you don't need to sell it, you can just ride that volatility out.
Absolutely.
Is that right?
Yeah.
Absolutely. Yeah.
Yeah, and it's easier. I like that saying where everyone's prepared till they get punched in the face. So it's a bit like that with markets, and we show every client the drawdown.
Yes,
and we will be very clear on that. Can you handle this drawdown? Like our balanced version dropped 22% in COVID. Share market dropped over 50. Oh, that's a real example. Yeah, like that's your $1 million would have dropped. 220 grand. It didn't drop in half like markets. Yes, ours had recovered by October that year, so it came back quite quickly with reweighting each quarter and other things. But they've got to be prepared for that's the reality. And we do put that drawdown up on the screen, so it's easy to look at all the positives and the greats, and we spend a lot of time talking with those clients around that, saying if you can deal with the negatives, the positives the easy bit.
Yes.
But how are you going to deal with that scenario? And there will be negative periods, and people get complacent. We're seeing a little bit of that at the moment. Returns this year are quite low because if you actually look at the share market, depending on the day, the All Ords might have only been up 1.5 to 2% for a 12-month number. Everyone's going, why isn't it up 10? It's like, that's what the market's actually done. And all of a sudden they start looking at returns. Oh, this looks great over here or something. Well, it's understanding what's happening with those different assets, investments. Markets that aren't liquid and aren't listed tend to be more steady, so they can look really good in these times until those assets actually get revalued.
Yes.
And if they've got lots of hard assets with large property and things that's not readily reweighted or revalued, we get interest rate increase and the economy goes off a bit. Well, they're not going to be worth as much, even though at the moment they haven't been revalued. So there's a square up coming somewhere, and people sort of jump at shadows a bit. Oh, that looks better, I'll jump to there and jump to here. And we do see a little bit of that herding going on, unfortunately, out there, and it's just understanding the underlying investments a bit more.
Yeah, and then so how do you walk a client through identifying what their actual tolerance is?
Yeah, we have risk profiling questions and alike, but it's it's asking that direct question. If you did have that $1 million and it did drop by that amount, how would you feel? Oh, okay, well, and I wouldn't like it. And then it's going back, okay, well, how much of a drop would be sort of a reasonable component? And then to Brooke's point, she'll normally jump in if we're doing a joint meeting around that bucketing. Well, actually, what we're going to have is that 1 year buffer. Ideally, let's have year 2 and 3 in buffer if you're really conservative, and then understand what the portfolio does. We ours reweight each quarter. We actually want some volatility. We accept it's coming and it's part of the process. Some people get that part of the concept, is it's actually there as part of the process. We want to reweight each quarter. Others, their view of the world is you should be able to see round corners and time what's coming.
That's right. Crystal
Happy
ball.
to meet those gurus. Haven't met one myself, because if they're that clever, they're doing it themselves. But some people see it that way, and that's why I normally pick on the engineers, because engineers are wired one of two ways. We have lots of engineering clients. I have a brother who's an engineer. Some are happy when you see the process, philosophy, methodology in what you're doing. That gives them, there's a methodology. They really embrace that. Market's dropping, end of the quarter, we're going to reweight. It doesn't matter what it is, it's going to happen. Others are sitting on the sideline. They're just waiting for the day for it to drop, and they're going to buy a whole heap, and it's going to go up, and they're going to sell, and they're going to time it again. That's really hard to do. So I just pick on them because they're the most people for as far as an actual background. It's almost a 50-50 split, and I'll have that conversation with the engineers. There's one of two ways. I just want to know which way, because
we can go either.
If you're philosophy, absolutely, we can help you. We're going to spend about an hour and a half running through. If you're looking for the other, we're not for you.
Yes.
Because we're not going to do that. That's not our belief or our philosophy. So it's interesting. And then particularly we find with ladies is if we can explain the philosophy and the reasons why.
Yes.
They're much more accepting, and when markets do what they do, they have ups and they have downs, they're less likely to react. We'll always be on the front foot. We know, especially for newer clients, if we haven't been through those downturns, you and I'll be, look, just letting you know, market's down 10, you're down 3 or 4. You should be down, it's going to be down.
Yep.
It's by how much? We're less than half. That's a good outcome. Okay, no, we can't control the world. This is what happens. We're going to reweight the portfolio at the end of the quarter. We're going to buy more while it's down. We'll come back stronger. Once they've been through some of those periods, they're very much, after that, very happy with the strategy. And I would think nearly all our clients could sit and repeat back, well, here's what you're going to do. Yeah, I'm going to tell you every time.
Yeah, that's right.
And that, I think, gives them that power. They know exactly what's going to happen.
Yes.
How would we react? This is what we do.
Yes.
Absolutely. And they also know that the income that they need is coming from cash only. They're not needing to sell shares when the market's down, and they've got that good at least 2 to 4 years of a buffer in defensive assets. And that's where that becomes so critical, because a lot of the time, and not to pick on men, but typically they'll be the first to query, why do we have this cash and why do we have this fixed income buffer? Let's put it in, go more aggressive.
Yeah. I'll time it and I'll do this and we'll do that. And then the second something drops, they want to sell that and buy what's gone up.
Yeah.
Chasing
your tail.
Yeah. And then that's normally when we do see the market retract, they go, oh, this is why we have that strategy in place. We don't actually need to sell anything to meet this month's payment. It's all coming from cash, and that's more of that lived experience of once you've been through those cycles, you see how the strategy supports your needs and how it can reduce potential impacts of market volatility.
And there's the strategy's been developed over years and years and years. And I think,
we can see the upside, downside. We know how the portfolio should react. So that's and it reacts as we would expect. But it's when other people think, oh, that's unusual. It's okay, maybe we need to explain this a different way and that philosophy. But, some people, it's just not for them.
And we're not for everybody. That's the reality. Yeah. And so with the portfolio and with the underlying investments, is there sort of a rough rule of thumb around time frames? Because we're talking about the cash, the cash bucket, and that's going to, hold, 2-3 years worth of, income. How far out should people be looking to invest if they are wanting to go into what perceived maybe more riskier assets or more volatile assets? Is it 3 to 5 years? Is it 5 to 7 years? Is there any sort of rough rule of thumbs that you sort of think
well
about?
Away from personal advice, with Brooke and I look at each other going, really, he just asked that?
Be general.
I know, general.
Okay.
General should be. I mean, look, for our clients, they're going to hold growth assets the whole way through retirement. They're going to still have a balanced profile. They're still going to have exposure, because if you're 60 or you're 70, you've still got a decent time frame, and we still need some access to those. They're producing income, which is probably more than cash most of the time as well.
Yep.
Our key is we re-weight it each quarter so it doesn't get out of kilter. So they're not, just because the share market goes up, they don't suddenly hold way more shares, and just because it drops, we should actually buy and take advantage of that, because that's what happened through their working life. That's why People Super works well.
Yes.
It keeps people away from making silly decisions. It actually does it and reinvests and keeps
you have
compounding.
to. Yep, that's right.
So in retirement, we've got to have that extra level and force it to do that each quarter and manually process to make it happen, because otherwise it wouldn't happen. Because when markets are down and things are scary and the TV's going, oh, all these horrible things are happening, it's probably the time, if they're good assets, we should be buying more.
Yep.
And nobody wants to.
No. And some of that's just gone into retirement. They've just signed off from work, and they're into that retirement phase. They're nervous.
Absolutely, and
but as you just said, you've got they're going to have growth assets.
Let me think of the words they're thinking. It's my life savings. I don't have time to get it back. It's never going to recover in my lifetime. The doom and gloom. It's every downturn. I would hear those words.
Yeah.
Touch wood to date. Hasn't come true.
No.
Because the portfolio reweight for the quarter. The world finds a way. Markets recover. Things move on, and we go from there. The people that don't recover are the ones that panic, move to cash, and go, when I feel comfortable.
Yes.
I'll put it back. I'll come back. I'll put it back in when I'm comfortable. I'm like, that's the worst thing you could do. So you took 100% of the downside. The market recovers back to where it was, and then put risk back on.
Yeah,
that's sort of the wrong time to be taking risk. Is the cheap runs or the easy bounce back is after a downturn, and that's where you just want to caution yourself against that human behaviour or bias.
Yep. No, absolutely. Okay, just in the interest of time, any sort of key call-outs or anything else you sort of wanted to cover off on this whole? Because it is quite an interesting topic, and as I said at the start, that we do get, there's lots of noise out there in the media, and it is obviously front of mind. Is there anything else that you thought?
Yeah, look, I think it fundamentally comes down to portfolio construction and making sure you've got a professional to lean on through those different market periods, because it can be nerving at times. Particularly, the media doesn't help. They'll always report an up day in percentages, and then when it's down day, they'll say it in millions of dollars shedded, and that's really just to fear the public. And often, if you've got someone that you can call, discuss your strategy with, and make sure you're on track and what's makes sense in the strategy, then that really helps people avoid those big blow up decisions and panic decisions as well. And making sure you've got those buffers, leaning on a professional to have all the underlying things that go into portfolio construction, essentially, and diversification, the reweighting, the bucketing strategies, they're also critical to avoid those big issues that can happen out there.
Yeah, and I think just talking to somebody like yourself, you do this day in, day out, and it's not just the financial side, it's also the emotional support that you can provide, and I think that shouldn't be underestimated, because that's so valuable.
And fundamentally, we all need exposure to some level of risk to ensure that our funds do continue to go in the right direction. It's just making sure the risk is managed well.
Yep. No, fair point. Troy, anything from you on closing?
Yeah, I think that I don't subscribe to any of that. Money's money. It's got a time frame. It's got to deliver outcome. It doesn't care if you're male, female, what you did for a job. It's got to deliver an outcome over time. So it's us getting in the way of all those things. And unfortunately, if we can get rid of those biases and those thoughts, and as Brooke knows and she's run through here, there's a process and a philosophy that we run through, and it's allowing people that knowledge and time and space to ask those questions to get to a point where they go, okay, I can see why you do that, and that will work for me.
Yep. Yep.
Reach out to a professional and don't be anchored by a previous bad experience too. I think so often people walk in and it's taken them so long to get through the door because they've had X amount in one company and that went wrong. That's where diversification avoids those big blow-ups, or they've had certain bad experiences and that really limits their future if they don't reach out for the right professional support.
So really just reach out to, I think, RFS Advice. that
give it a blatant.
Well, we may as well. At the end of the day, we're a team of professionals. So look, if today's episode has raised any questions or you would like further information, please do reach out, rfsadvice.com. And we're more than happy to organise a time to catch up. So, Brooke, thank you for joining us. It's always a pleasure.
Very welcome. Thank you for having me.
Oh, welcome.
And I noticed I wasn't allowed to say the web page because I always mess it up.
Yes, exactly. Well, that was a given. But thank you, Troy. Always a pleasure.
It is Greg.
And thank you, Oliver. He is sitting in the background there. We'll get Oliver on the show one time, but he is fantastic here in the studios of 4CRB. So thank you very much. So, ladies and gentlemen, take care. Until next time. Thank you.